Since they were announced at the start of the month, Trump's tariffs have caused turmoil on the markets. But is there any good news for your investments? Welcome to the Which Money Podcast. Hello, I'm Rob Lilley-Jones, sitting in for Lucia Ariano this week. And to get into this with us, I'm joined by Which Investments expert, Josh Wilson. Josh, welcome.
Pleasure as always.
Great to have you here. And also, pleased to say we are joined by the investment director at AJ Bell Russ Mould. Russ, welcome.
Well, thank you, Rob. Thank you, Josh. Lovely to be here.
It is brilliant to have you both here. There is plenty to get into on today's episode. Now, I considered today's episode almost part two from what we were talking about last week, because last week on the podcast, we were talking about the positives of Trump's tariffs and how they appear to potentially be good news for your mortgage. But for your investments, the picture is less clear. Josh, if you want to take us back to the start of the month, what exactly did the US president announce?
So essentially, 2nd of April was Liberation Day, where Trump stood in front of the cameras with his big chartboard of all the countries and the tariffs that he announced that he was going to place on them. He placed a flat 10% on all imports into the United States, as well as higher tariffs on selected goods from selected countries, most notably China, which got quite hefty tariffs placed on them. This initially caused, all kinds of ruckus in the markets. Since then, the US has announced a 90-day pause on some of the higher rate tariffs, but not the 10% base one is still in effect, and the higher rate tariffs on China remain in effect.
And just to clarify here as well, Russ, maybe you can help us out on this one. I know our listeners will probably know this already, but the UK and where we stand on these tariffs, we have that flat 10% rate.
With the exception of cars, steel and aluminium, which are subject to a higher rate, which obviously is a challenge for those industries. And that's another hot pressure point between the two governments when it comes to hammering out any deal right now.
So it's never simple when it comes to President Trump, is it? So thank you for that clarification. And then, Josh, since all of this happened, as you said, Liberation Day, not your words, I should add, President Trump's words.
Yes, indeed.
There have, of course, been counter tariffs, higher tariffs for, as we've already mentioned and you've touched on, countries like China as well. But Trump has been rowing back on some of these announcements. You mentioned, some of these have been put on pause.
Yes, so essentially what happened was Trump placed these tariffs. It upset the markets, but in particular, it upset the bond market. Now, the bond market is very important because that decides the cost of borrowing for the US government. So initially, when there's stock market instability, you might expect to see bond markets doing better because people will flood into bonds because it's traditionally seen as a safe bet. But what actually happened, if you look at the bond market, was it went the other way. And yields started going up while bond prices went down, which essentially means it costs more for the US government to borrow. Now, this panicked Trump and the American government for obvious reasons. They don't want bond yields to go up. It costs them more to borrow. There are various reasons why the bond market went into this kind of territory. Basically, it's partly to do with the fact that people are worried about essentially, the solvency of the American government to some extent, but, they don't want to take that risk of buying American bonds. There were also, some people were using bonds essentially as collateral while they were doing, contracts for difference and various things, and they had to liquidate their bonds to make margin calls. But essentially, Trump saw what was happening in the bond market, panicked, and that's when he instituted this 90-day pause on most of the higher rate tariffs apart from China.
Now, talking of the bond market, just before we move on to the next point, Russ, this has got many people harking back to the infamous Liz Truss mini budget. That was one of the big impacts there, right?
It was, and I think it comes back to the old James Carville comment, Bill Clinton's former economic advisor when he was president, that the bond market can intimidate everybody because it's just so big and it's so powerful, particularly in the US. It's $28 trillion worth of publicly held US government debt. And as Josh was saying, if the yield on those goes up, so the price goes down, it costs the US government more to borrow, which when you're already borrowing $36 trillion, a figure estimated to reach $58 trillion by the Congressional Budget Office within 10 years, and that's costing you $1 trillion a year in interest already, which is more than you spend on defence and education and transport put together. And you have to refinance half of that inside the next 3 years at what will be a higher rate right now. You need to try and keep a lid on those borrowing costs as best you possibly can. Now, that's why Elon Musk is there with the Department of Government Efficiency, trying to reduce government spending and rein the overspend in. It's allegedly one reason why the tariffs have been introduced, to raise some revenue and offset it in that respect. But yes, certainly one thing that Treasury Secretary Percent is thought to be extremely interested in is keeping a lid on those yields on that government borrowing, because otherwise you get involved in a spiral of higher interest rate, higher interest payments, higher debt, quantitative easing in all likelihood to try and fiddle your way out of it. That could be inflationary, which would mean, higher bond yields and back we go around again, which is not a developed market. That's an emerging market. That's a tin pot republic, which is not something we're used to seeing spoken of in anywhere when it comes to the United States of America. Yeah,
it's potentially, as you said, some of the language you've used there, potentially very dangerous, uncertain territory, especially for investors, as we'll get to.
Yeah, and from the narrow perspective of investors, if you own US bonds, you'll be thinking, maybe I'll dump the ones that I've got and buy ones that offer me a higher coupon. But also the US 10-year Treasury will be the risk-free rate, because America has never defaulted. It's always paid its interest. Or you might have to take inflation into account there, but in nominal terms, you've always been fine. But if you can get an ever higher interest rate on US Treasuries, where there is, in theory, no risk of default, why would you start taking more risk with things like shares or commodities? So that is one thing from an investment point of view that you would need to think about if this spiral were to ever develop, and clearly Percent and Trump and his team are doing their absolute utmost to avoid that.
If we take a step back, you mentioned before one of the reasons, or supposedly one of the reasons why these tariffs were introduced in the first place, was to generate revenue to help tackle the deficit and the amount of borrowing there. What are the other things that Trump is trying to achieve with these tariffs? And I appreciate it is very difficult to try and get into the head of President Trump at times.
I mean, I'm not an expert in American politics, but from an outsider's perspective, the Republican Party looks like a bit of a three-legged stool in this respect. You've got some who genuinely believe in tariffs for income, tack on the Doge, let's try and tackle the budget deficit. You've got some who believe in it for long-term reasons, which I think is where the president's coming from. We want to make overseas goods more expensive, so we produce more stuff at home and bring more jobs home. And that is a long-term economic plan, you could argue. And then there are clearly some who probably sit somewhere in the middle who view it as a means of generating revenue with which you can cut income tax. Because the income tax is probably the most hated tax in America. It offends many libertarian sensibilities. So you've got three different strands, some of which are tariffs for tariff's sake, which means they're a win now. Some of which are there's a multi-year economic plan, and the income tax is probably somewhere within his presidential term. You can't get all three of those to work at the same time. If you bring all the jobs on board and you reduce your imports, then you're going to not generate as many tariffs, are you? So it's an extremely difficult three-legged stool to get it to balance, let's put it that way. At the moment, the president seems to be driving the American long-term jobs by American agenda. Let's see if they can make it stick. We've already heard there's more than a few exemptions slip past, and Josh didn't even mention the Apple exemption, which obviously big tech had been crying out about the week before.
Very true. And I'm just going to interject there as well, because, Russ, I think you're completely right. And I think it goes even a little bit deeper than that as to why Trump is essentially doing this. And I think to really understand why he's doing this, you kind of have to go all the way back to 1971 during the Nixon shock. And what Nixon did back then in 1971 essentially was he basically blew up the existing financial system, much as Trump is doing today. So all these commentators who are saying this is unprecedented, this has never happened before, it actually kind of has. If you go back to, as I say, 1971, Richard Nixon, what he did was he took America off the gold standard at the time, and he also put 10% tariffs on all imports into the United States. Now, what he was aiming to do was he wanted to massively devalue the US dollar. At the same time, he wanted to devalue other currencies, and he wanted to turn America basically into kind of a trade deficit country, where all the goods from Europe, from Japan, would be sold into the United States. The United States would buy it. Dollars would flood the rest of the world. The dollar would become the reserve currency, whereas before it had kind of been gold had been the global reserve. So it became the US dollar instead. Those dollars then flooded back into America in the forms of treasuries, real estate. That's part of how America became so dominant financially. Now, some people are calling what Trump is doing the Trump shock. Essentially, he's trying to do something kind of similar where essentially he's looked at America's position. He's looked at the trade deficit, which has grown massively, and the government deficit. And he's kind of decided, or perhaps his team has decided, that this is unsustainable. There's going to reach a point where the value of the dollar has got so high, the deficit has got so big that all these central banks around the world that are hoarding dollars panic and are like, this can't go on. We need to get rid of all of our dollars. Maybe a different currency becomes the world's reserve currency. Trump and his team, that's like their biggest fear. They don't want that to happen. So what they're doing is they've introduced these tariffs. Now, a lot of people saying this is kind of crazy, but there is method to the madness, I think, in that what I think he's really trying to do is he's trying to devalue the dollar. He's trying to get concessions from different allies. So from Germany, he wants more of German industry to relocate back to America. You know, he wants Volkswagen, whoever, car makers to rebase their factories back in America to avoid the tariffs. He wants, for example, Japan to sell off some of their dollars. He thinks they've got too many. It's this whole balancing act that he's trying to do where he's trying to devalue the dollar, but he doesn't want to devalue it so much that it stops being the world's reserve currency. He's trying to have his cake and eat it at the same time. Where I think it kind of breaks down, and I don't know whether Russ would agree with me, is he's doing this without the requisite industrial strategy that you would need to kind of back this up, I think.
Yeah, he isn't providing the support that you need. You can try and indirectly influence industrial policy through tariffs, but in the end, if you haven't got the GDP growth is labour force growth times productivity, and that is the end of that discussion. So anything that you need to do in terms of tax or incentives has to be there to help drive those two things. And tariffs don't make a difference to either.
I mean, I should say, Josh, thank you for the history lesson. That was fascinating. So thank you for taking us back to 1971. I mean, already in today's episode, it's clear how much is happening, how much is uncertain right now. So for investors, Russ, safe to say it's been a tough few weeks, to put it mildly. Have there been any winners in all of this, if you're an investor, or has everyone lost?
Since the 1st of January, and I've got my cheat sheet here ready for you, the Brazilian stock market's up 8, Hong Kong's up 7, China's up 7, Germany's up 6, and the FTSE 100's up 2. By comparison, the Dow Jones is down 10 and the Nasdaq's down 18. So there's your answer. There's always something to do, and that's before we get to our good friend gold, that's obviously up an awful lot. And in fact, over the last year, when the Dow and the Nasdaq and S&P 500 are basically flat, gold's up 43% in dollar terms.
I mean,
top $3,500 per troy ounce, I think, which is a record.
Yeah.
I mean, some of those figures are really, they stand out as being particularly
Put it this way, if you
stark.
said to somebody a year ago that America would underperform gold and Hong Kong and China and the UK and Germany, they'd have laughed at you. But that's what markets do to you, right?
I mean, Russ, given some of the figures you've mentioned there, and we'll get to, a bit more specific sort of advice or what investors maybe could look to do a little bit later on, but it sounds there like it's obvious where people should be thinking of investing, but presumably it's not that straightforward.
It wasn't obvious a year ago. I think the one flag that you had a year ago was that, and this isn't the benefit of hindsight, I hope, but it's, in the end, valuation is your ultimate guide to long-term investment returns. As Howard Marks puts it of Oak Tree Capital in one of his recent blogs, it's not buying good things that matters, it's buying things well that matters, and that means paying the lowest price you can manage because that protects your downside if something goes wrong, and it helps maximise your upside if something goes right. And there were lots of voices out there a year ago saying the US market's really expensive. You could make up all sorts of reasons why. The Mag 7 are a big percentage of it. There's tech. There's da. But in the end, yes, the cult of American exceptionalism has a lot of good ground behind it. But you are paying a very high multiple of market cap to GDP, market cap to sales, GDP to gross value added, Schiller price earnings, bog basic price earnings. They all made America look expensive, no matter how you sliced it. So the financial markets were already convinced that America was great, actually. And now it's actually got reasons to doubt that because it's wondering what on earth's going to come next in terms of dollar assets and dollar strength. So nobody knew what Trump was going to do. Nobody knew he was going to win a year ago. So you can't say, well, this was obvious. But what was there was the fact that you had a very lofty valuation attached to a very popular asset that was at a record high percentage in terms of market cap, global market cap. So it wasn't going to necessarily take a lot to make people reassess paying top dollar for dollar assets.
Given everything that we have said, actually, Josh, we have seen that some of the markets, the S&P 500 in particular, they're bouncing back a bit now that we've seen the president roll back maybe on some of the announcements that we saw?
Well, the first thing I would say to any investor is don't panic. That's the first thing. I would say the second thing is take a step back, look at your portfolio, see what your exposure is like, see what your exposure to the American markets are like, decide whether you're happy with that, whether you're not happy with that. Your investment platform should be able to help you with this as well. They should give you that information. And if you feel that you're not happy with your exposure, you can dial it down a little bit. But that's the first thing I'd say. The second thing I would say on markets bouncing back, well, part of that is to do, as I say, with the 90-day pause on many of the tariffs that Trump introduced. But I think there is one more thing that it is worth bearing in mind, and that's that Trump's approach is two-barreled. He's fired his first barrel, which are these tariffs, but we still have the second barrel to come, and that's his tax cuts, which we do know are coming. He's trailed them endlessly. When they do come, don't be surprised if you do see a more dramatic bounce back in markets, particularly American markets. Now, obviously, there's no guarantee of this, and things are likely to remain volatile for some time, but I do think that is worth bearing in mind.
Okay, well, let's pause for a second. We'll be back shortly to consider what you can do with your investments to ride out some of that unpredictability that we've already talked about, what all this means, of course, for your pension as well, potentially, and we'll explore whether this could be the very best time, in fact, to actually start investing as a beginner. So, this kind of event seems like the right time, potentially then, to consider if you have the right investments in your portfolio. So, Josh, what should investors have in mind right now?
So I think the key, particularly to periods of volatility like this, is diversification. Diversification of your portfolio. Now, what essentially that means is don't have all your eggs in one basket. So, don't have everything you own bet on, let's say, the Mag 7, or American bonds, or even gold, whatever it might be. You want a nice diversified portfolio, which means a good mix of equities, cash, bonds, commodities, in whatever kind of proportion you feel is appropriate to your current circumstances.
I think the two things. One is always that investing is about being able to sleep at night, because that's what it's there to help you do. So if you've got something that's stopping you sleeping at night, then review that very, very quickly and have a really serious that you've probably taken more risk than perhaps you appreciate. And ultimately, whether you're starting off or whether you're an experienced investor, there are always four questions to ask yourself, which is why am I doing it, i.e. what's my ultimate goal? What's my time horizon? What's my target return, which is a function of how much money have I got, how much money do I want, and how long am I going to get there, and how much risk am I prepared to take in the meantime? And risk is defined as willingness and ability to take losses. So once you answer yourself those four questions really, really honestly, they will shape the asset classes that are most suitable for you, the type of research that you need to do, the platform that you wish to use, the instruments that you wish to use. And it will actually save you a lot of research because you'll only be focusing on a few certain key things.
I think that's really important. And I think that, again, this is something that your trading platform should be able to, your investment platform should be able to help you with, which is reviewing your portfolio, seeing where you're invested, looking at the funds that you're invested in. Really look into it. What companies are being held in these funds that you're invested in? What are the proportions? Are you happy with that? Look at things like their price to earnings ratio, look at things like their debt position, expected profits. All of these things are going to be really key.
It's really interesting what you're saying here, because it just sort of presents to me a question which maybe a stupid question, might not be, but how easy is it to diversify your portfolio, or how reactive can you be when something like this happens? Are you committing to a specific set of bonds for a certain amount of time, or can you, drop some stuff, pick some stuff up really quickly? Or is that, not a particularly wise thing to do?
I would caution against trying to play the market, as it were. Don't go day to day being like, okay, today bonds are down a bit, equities are up a bit, I'm going to switch this, switch that. That's generally, you're going to really struggle with that kind of approach.
Yeah, and with a bond, if you buy it at issue and hold it to maturity, unless the issuer goes bust, which chances are is pretty thin, then you're going to continue to farm your coupons, your interest, and get your original investment back at the end. okay, you have to think about inflation, but that can nevertheless still form the bedrock of a portfolio because it will keep the income ticking in. So again, you would only lose money on a bond if there was a bit of a panic and you were to panic and sell. So again, a lot of it is about waiting.
Yes, that long-term viewpoint. Have an eye on the horizon, you know. Volatility can often be fairly short-term. Over the longer term, markets do tend to correct themselves, continue on something of an upward trajectory. So do bear in mind, I think it's worth keeping in mind that longer-term view.
If you are going to try and look at the markets in a slightly shorter term way, volatility is your friend, it's not your enemy. The trick is getting from A to B and having that balanced portfolio. But if there is volatility, it's an opportunity to either sell expensively or buy cheaply. And that's the old Buffett thing. If you are determined to try and time the market, and he says, really, you're probably better off not doing so. But at least that's when you're fearful when others are greedy and greedy when others are fearful. At the moment, there's a little bit of fear out there, which may be of interest to some contrarians.
I'd agree with that.
I think this is potentially a good time then to bring in one of the questions that I was saving for a little bit later on. And I mentioned as we went into the break, we should probably talk about pensions. Now, we've talked about, people's eventual long-term goal and, obviously where people are in that journey will differ considering, how old you are, for example. So, I mean, Russ, we haven't mentioned pensions yet. If you're still a few years away, is it best to sit tight? But if you're going to retire in the next few years, is this more of a concern?
I mean, clearly, the more time you have on your side, the more able you are to ride anything out. And even if you've clicked the default button, you'll probably have a fairly diversified portfolio anyway, if the truth be told. So you will have a bit of a spread of cash, shares, bonds, maybe some real estate, commodities. It would be nice to think that you did. I mean, some have done really well in the last 12 months, 24, 48 months, and some haven't done so well. But certainly the longer time you have, the better. If you're coming up to that time when you may be looking to go into drawdown, again, you may own an investment product that does it for you. There may be a glide path where it moves you away from riskier assets like shares into allegedly safer issues like bonds. So that, again, should help. But yeah, if you are coming up close, then you probably will be taking a little bit of risk off the table, or you might have been thinking about it anyway, if the truth be told, particularly if you had exposure to the US, which had done brilliantly. Everybody was singing its praises, and it did look expensive.
So if that's the end of the journey then, people who are approaching retirement, if you talk about the start of the journey, is now a good time to invest? We've mentioned all the volatility, but is there an opportunity for people who are considering, might be listening to this podcast thinking, this is something that is of interest to me and something I'd like to get into?
I think you need to answer those 4 questions first, which is, why am I doing it? What's my time horizon? What's my target return? And what's my appetite for risk? And you've got to sit down and work out those honestly, and also be honest with yourself. If there was to be some sort of extremely unexpected event and the whole thing were to halve, would you be able to sit that out?
Absolutely.
Or would you be found in a position whereby you just had to sell at the worst possible time because you needed the money? So the first thing to do is probably make sure you've got 3 to 6 months of cash to cover all your bills tucked aside, just in case there's an unexpected market event or, heaven forbid, an unexpected economic event that costs you your job. These things can and do happen. Nobody's really talking about a recession yet, but the jungle drums are getting louder. So that's the first thing, is to set aside the bedrock and then start thinking about taking additional risk.
Absolutely. That rainy day fund is absolutely key. As Russ says, 3 to 6 months worth of cash set aside in an easy access saver account, something like that, really vital. Once you've got that, then you can start thinking about starting an investment journey, and if you do decide to go down that route, do your research.
And are there other barriers of entry that we need to consider? Do you have to be on a certain salary or have a certain income to start investing?
No.
Josh, please.
Yeah, no, not necessarily at all. I know that there are particular trading platforms that have very affordable fees, very affordable trading fees. So it's the barrier to entry is very low.
And presumably, Josh, this now sounds like, I'm being overtly, maybe you should go to the Which website, but there is some really helpful advice on there as well.
Absolutely, yeah. I'll take this opportunity to plug our advice guides, where we do have plenty of material that's great for any level of any investor at any level of their investment journey. We've got tips for beginners, tips for people who have been doing this for years. one thing that I would recommend looking into is our review of investment platforms, where
They keep us very honest.
Yes, yeah, Russ will know about this. Where we review all of the investment platforms, we look at their fees, we look at their ease of use. That, I would say, is an absolutely invaluable tool for any would-be investor.
And then before we wrap up then today, I feel like it is worth getting your final thoughts, because it's been so interesting hearing sort of the context behind why we are where we are. But the difficult thing is what happens next and what might happen next for investors. So, I mean, Russ, if you want to go first, and then Josh, you can finish off.
I think my final thought is, over the last 15 years, we've become accustomed to low inflation, low growth, low interest rates, which has favoured certain types of asset classes: technology, long duration assets, bonds. The big question everybody needs to ask is the water in which we're swimming now different? Is the temperature different? And my inclination is to think, well, possibly, given that we're seeing some fairly major events that could send things in a dramatically different way, just as the Nixon shock did in 71. If that's the case, the question to ask yourself is, well, if the environment has changed, why should what worked for the last 15 or 20 years work again? And I think that's the question if you are starting up, that's the first question to when you're reviewing your portfolio. I've had a really good time with that, but now everything's different. So does that mean that I need to think about it in a different way and approach it in a different way? And the answer is possibly yes.
On that note, America never did return to the gold standard. So anybody out there
it was supposed to be about 3 weeks, wasn't it? I think, and we're about 40 odd years in now, 50 odd years in.
Exactly. So anybody out there who is saying to themselves, "Oh, I'm just going to wait for the end of Trump's presidency, then it'll all go back to normal, whatever normal is," don't bank on that. Don't bank on that. You know, we're currently in a bit of an era of volatility, and who knows what's going to happen
JD Vance
next.
could win the next election,
Exactly.
And then there's maybe no change. I mean, so you definitely can't bank on that, and shouldn't bank on that. No, correct.
It's been a fascinating listen. We will put some links in the description for today's episode to some of those advice guides that Josh was mentioning earlier on. And Josh, thank you for joining us.
Thank you very much for having me.
And Russ, it's been lovely to have you here in the studio.
Thank you for having me.
Thank you very much.